everybody here in New York. I guess there's nobody else but myself remotely. I guess.
I'm hunting them down. Give me a second.
So good morning, everybody. My name is Mrozowski. I'm a managing partner of Silicon Hill Ventures, a boutique investment company from San Francisco, and I'll be conducting a fintech panel. It's pretty exciting.
Thank you.
And today we have a great panelists. Let me just start by kind of taking the role, and then we have a Phil Toth, founder and managing director of QueensGiant, and then we have Oliver Mitchell, managing director of FFVC.
Oh yeah.
And I'm not sure if actually if Oliver is going to make it, or he's going to.
Oliver's not going to be able to make it. He was on the book somehow.
Okay, sounds good.
But I'm hunting down Tom Jardine.
Tom Jardine, founder 01 Analytics, and then we have Asai Suhas. Is that the proper name? Did I butcher your name, or is that how it's? Okay, great.
That's right.
Founder and CEO of WinPra. So in any event, a little bit about me. I'm just a 30-year or so plus experienced person from Silicon Valley doing all kinds of startups. And I think that my kids actually have a much better outcome in a fintech than I ever had with anything that I've done in my life. So one of them has a very successful fintech company sponsored by YC Combinator, and he's reached about $400 million level. So I'm really proud of him. And I personally actually I'm doing so-called embedded fintech, which is a product that one of my companies working on right now. But anyways, rather than talk about myself, let's talk to
Arthur. Tom is here.
Huh?
Tom is here. Tom Jardine is here.
Okay. Hey, Tom. So rather than talk about myself, I'd like to start introducing everybody and hearing a little bit about who you are and who you are representing. So let's start with Phil. If you could tell us about yourself and then your company, and then we'll go to the next panelist.
Sure. My name is Phil Toth. I work at, I founded a boutique investment bank called QueensGiant, named after the tree in IVYFON Park. And we focus on fintech, specifically what we call fintech advisory. But we also do lending platform finance. Where we finance lending platforms. There is a lot of crossover between some of like the fintech lenders and the lending platform finance, and then commercial real estate, where there's also some crossover between fintech, or we might call it prop tech, and that's really our specialization. So we try to go deep rather than wide. Within the fintech advisory practice, a lot of it is capital raising for really any stage of company, but also finding people that can help them grow their business, which is really where we're seeing a lot of activity, more than we have before. People got into investments maybe the last couple of years, and now they're looking for someone in the financial services community to help tie up their business and expand it. And then in addition to this, I also I'm an instructor at the Harvard Fintech program. I'm actually the head instructor at the Harvard Fintech program. And then I teach at Columbia too.
Well, that sounds like a very interesting set of mixed careers. Very nice. Thank you very much.
It is, but there's a little bit of demand, for you. Then you have to, and then I'm married, and I have kids, so to balance it out.
Sounds good. Well, let me introduce you to Thomas Jardine.
Hi there. I'm Thomas Jardine. I founded 0 to 1 Analytics, or data analytics fintech firm. We focus on execution and transaction analytics. We developed a cloud-based software as a service, trademarked BestX Now. And what the BestX Now system does is it exposes transaction costs. It enables you to manage the execution process and can provide significant savings in transaction costs for the family office. On a personal side, I teach at Columbia as well in the applied analytics department. Yeah, that's it. Glad to be here.
Well, thank you so much. And then Sai.
Hello all. Firstly, glad to see I'm sharing stage with people who are teaching at Columbia. I just graduated from Columbia class of 2021. And while as a student, I was working with Ministry of Commerce, Government of India, did many projects with them. And basically, how do we attract foreign direct investments to Indian infrastructure projects, real estate, solar power plants, and all of those things. And during that came across that there's so much data out there with respect to projects, with respect to market, GDP, inflation, property data, and my personal risk tolerance before investing in a specific project as an investor. So saw so much data out there, and then did a few research projects at Columbia, and then transitioned that research project into a startup. So what basically, I'm a founder and CEO of WinPra. WinPra stands for Wise Investment Prediction Assist. It's an AI tool, a big data tool. Basically, when we hear about real estate or any type of asset, it's not brick, walls, or mortar, or glass, or the view. It's about financial models. It's about underwriting models. It's about investment memos, investment decks. So all of those materials that I just said, it's so static in nature. They are not changing. They are not updating themselves based on change in market information or change on basis of property fluctuations or property performance fluctuations. It's not, these models are not changing. So we are developing a tool at WinPra where your AI, your underwriting models, your financial models, your investment decks, they update themselves based on change in market conditions, based on property performance, and based on my risk tolerance, if at all it's changing as an investor. So I can monitor my real estate assets now in real time based on changing market conditions and surrounding information. So that's the tool we are building. So yeah, that's all about WinPra.
Okay, great. That sounds great. Listen, we've noticed the wave right now of the fintech funding recently kind of taming down, right? Because it's been going up, and then there was a lot of money being thrown at the fintech in general, and then you didn't have to necessarily produce the revenue. It was all about getting the footprint and then getting enough of the users of the product in order to actually sustain a money raise, right? So the times are, I think that they're changing. There's evaluation of the business models and such. So there's no longer like throwing the money on around the giant round C, D, and Fs without questioning the sanity of the companies. So I just wanted to find out from you guys, like, what do you think that the future of the fintech is in terms of actually availability of the funding in this year for any of the fintech products, or which fintech products may be the most palatable to the investors. Maybe Phil, you have you have opinion on?
Sure, I do. It hasn't always been popular either. I mean, we don't do C, D, F, G, things like that. I mean, I never wanted to do it. It's tempting because for us, we make money on the transaction closing, but everyone needs to win in order for it to be a good transaction. The way that I see things, it was an epiphany for me when I was told to do, a consecutive round. Okay, we'll do C, D, E, F. And I said, well, yeah, but it's just counting on stepping up your basis. And then of course, founder came back and said, well, yeah, that was the dumb money, like in Uber that came later. And I said, well, you expect me to find someone who's dumb? He said, yes. I said, I'm not, I'm out. I'm not doing that.
Smart, yeah.
I will not do that. I'm not going to court. I'm not going to have pissed off investors or, and I don't believe in you. And so, I think it's kind of going back old school, right? I remember there was also a lot of resistance early on when the financial incumbents didn't really want to accept anything. And, now then when they pile in, the valuations go up and everyone's really looking for the takeout of the big financial institution. For them as a rounding error, to have it's not really a big deal. So, I mean, the way I, like to position it is how do we get there, right? How do we create value in the transaction by finding the right partner? Well, sometimes it could be just money, but most of the time it's something else. So, now that, people up in Silicon Valley or other venture capitalists have really loaded up, I think the next stage is where a lot of our activity's been, which is trying to make these portfolio companies grow, right? Not just be capital raising. And another anecdote, one of the people who joined me early on, and she since went to go work somewhere else. We were talking to a fintech company, and she said, what is your business? And basically, we came back with was, you're in the business of raising money, right? That's your business, right? And I just don't think that will be, that's not long lasting, right? The companies are getting bigger, are well established, and then the smaller companies need to have a plan to get customers, right? I'll give you another kind of example where when the lending platform, Ray, who I work with, he and I worked on the first ever securitizations of what were called peer-to-peer loans. The Lending Club, like, what was it, 7, 8 years ago? And that was a huge flood of institutional capital in the space once you tapped into the securitization market, on what people were laughing at us at first, right? An internet loan, come on, this is ridiculous, right? Isn't there more fraud if someone seeks you out on the internet rather than targeting someone through direct mail and all the naysayers? And I was like, hey, a consumer loan's a consumer loan, right? And if you want to change the price here a little bit, fine. But eventually this is going to be, the standard. That market exploded, right? And then when that market exploded, all of a sudden the money piled in. And they were giving ridiculous, not just valuations based on origination volume, which ironically is the same thing that happened in the subprime crisis. Okay, you ramp up your volumes, right? Then you're rewarded, not the performance of the underlying loans themselves, right? And so now it all comes back, right? And you got, as an investor, family office, institutional fund, or whatever you are, insurance company, you just have to, be sensible about it. Eventually, that will always win over in the long term. The smart people who try to guess the timing right, realize that that's all they're doing, and then they exit. Like, I had a couple of friends, right, that they just hit it big, and they were smart enough to go, well, I'm not going to be doing that again, right? And they just left. Right? They left, and now they're in their own family office. Mm-hmm. But to do it over and over, iteration after iteration, eventually it just regresses to the mean, and you're going to see that happen with a lot of the fintech companies on a go forward. So lastly, I'll just say a lot of our activity right now is, again, it's like VC sponsored firms that want us to say, okay, marry us with one of those financial institutions in New York, right? So that I could grow this business. And honestly, in some of the cases, they probably overpaid for it.
So essentially, some of those guys that already raised a bunch of monies that they don't know how to productize, convert it into the product. They come to you and say, hey, we still have a $200 million left in the bank with the like $1 billion valuation, but we're bleeding money. And so I want to talk to you and then figure it out how to make it into a growing company. Is that?
Yeah, like if they have a service that we could market, right, then the investor, it becomes a 2 + 2 = 5.
Exactly.
Like I said, we get off the A, B, C, D, E. Okay, well, this round was $100. And, oh yeah, the next one has to be 150. Next at 200. Well, I mean, that's like we're already out. I mean, we don't care, right? But if it's, hey, our last round was at 100. Can you find someone that can help us grow the business where it's obvious 2 + 3 = 5? Right. And it's like, okay, the moment this investor's in the deal, then you're better off. Example would be like if it's an insurance tech company and we got them a deal with MetLife or something.
Oh, nice.
Their service is a software as a service plugged into the insurance business. MetLife brings immense value to the company. That's what we want to work on. I hope that's the future because I got a lot, work for it.
Nobody has a crystal ball.
Yeah, I hope that's the future. Yeah.
Exactly. Well, Sai, you guys have like all of you have a big analytics aspect to your companies, and then Sai, your company WinPra. How does that? What's the position? Sorry about the peacocks. I'm in California, so yeah, I'm allowed to have wild animals. What is the WinPra? How do you fit in the actual financial market? What's your hook to the fintech in general?
Great question. So I've been speaking a lot about analytics and not the finance aspect. So again, real estate, as I said, it's about combination of financial models, underwriting, and the transactions that happen inside. So there is another aspect, the other meaning of real estate, why people invest and what they want to see in return is maximized cash flows. So real estate is all about cash flows, and what they want to see as a result is maximized cash flows. And to get to there are three things. One is optimizing the internal supply chains in real estate. You work with so many internal stakeholders. If you're building a property or you're managing assets, you work with multiple stakeholders, both internal and external, developers, operating partners, brokers, and all of that. So there's optimization of supply chain, each of these partnerships, how you build, how effective those partnerships are. And then the resource allocation. So optimizing resource allocation is a very, very critical aspect in when you're allocating whether do you want nice interior aesthetics or do you want a nice park outside. So how do you get more leases signed? So all of those things. And the third is the legal aspect for real estate. So if we can sort of optimize all of these three things, we can have maximized cash flows. So what we are working at this point is, okay, so these are the three things, and real estate is a living process. Everything is it's so dynamic in nature. So what is our unique selling point is basically markets are changing, everything, the surrounding information, all of these things are changing. How can we sort of all these three things, how can we make it dynamic instead of just Excel models or PowerPoint presentations or just in some sort of a document based on these things. If you can change those and if you can let these stakeholders know, the real estate asset managers or the decision makers know that how your property is performing based on these changing conditions, then they can take better decisions at that point in time based on these changing conditions. So with respect to the finance aspect, to get the maximized cash flows, you should always take a decision based on the information you have at that point in time. And if you have the updated information at that point in time, updated models, updated financial models, you can take better judgment, next best action in terms of maximizing cash flow. So we are intersecting the transaction aspect, the cash flows aspect, and the analytics and big data aspect. So this way you can have better results for asset managers. So yeah.
So and that's in the form of some kind of a product, meaning that is that the service that you provide, is that the piece of software, the SaaS software, or how does
Is it a
the-
consulting service or is it
Oh,
SaaS?
sorry, it's a SaaS software. It's an AI product, and yeah, it's a
And
SaaS
people have to
AI.
become educated on how to use it, or does somebody from your firm facilitate it?
So it's basically like other asset management platforms that you see. There are so many asset management platforms, Dealpad, Dropbox, like kind of few that you have. But only thing the difference is in Dropbox, you have all these static models and everything, right? But whereas in WinPra, it exactly has the Dropbox kind of interface, but all the models, you get the alerts. As soon as GDP or inflation or rent rolls, anything sales comes, anything changes outside, you get the updated models and you get the alert in terms of how your model has been updated. Now, instead of if you're looking at buying a property in like a state that you don't know, instead of making 10 phone calls and looking at, oh, if that property is right or if the location is good for my investment, you can just tell WinPra, this is the location, this is my risk tolerance, and it automatically gives you relevant
So
models.
it's like a data feed.
Exactly.
Okay, interesting. You know, what is, or just one second, let me just cut in here. You know, one thing that's really interesting in the fintech world is like, you know, if you're investing in something, let's say, well, how are you making money? Is it a new opportunity from the fintech, or are you just, you know, reducing the number of people involved in the process? So there's just a kind of like a HR arbitrage, you know, or are you producing more analysis? So I had an experience because I ran analytics for a very large casino in Connecticut many years ago. One of my first jobs at a Wharton. And what we found is that our analytics were great, but we could only get an incremental, and I think IBM had the same experience, only an incremental value from that. Like we didn't get new customers from having superior analytics, right? But we could certainly milk out an additional 10% from the existing customers, right? So you know, what are your thoughts on that from a fintech point of view?
I mean, like I've been like either sales and trading or investment banking for like 30 years.
Yep.
I mean, our analyst pool, it's hard to really determine whether it's a cost center or not.
There you go.
I mean, it's, you know, and it's a very expensive part of the investment bank, right? I mean, they overpay analysts, right? Because but then it's like opportunity cost, right? And usually the best analyst is actually running also the best producer, but they just were able to develop other skills. You know, it's the same on the buy side, I'm sure.
Like, so, yeah,
Right, it's like you got to have a lot of skills. It's like, you know, it's a very hard job. You know, sometimes you have to partner with people because you can't do it all. But segmenting them, like maybe missing opportunity, it's opportunity cost. But the dynamic nature you're talking about is like you don't want to miss out on an opportunity. You know, you gotta be on top of things, and if you got to rerun the models. I mean, you were telling your story. I was like, oh yeah, oh, something happens, and now we got to rerun the thing, and we're up, you know, in the middle of the night trying to figure something out. I mean, it's going on all over the deal business, or Wall Street or California or whatever, is that we're always trying to update stuff, and you're chasing the tiger by its tail.
Mhm.
You know, but we spend a lot of money on it, right?
sure.
I'm sure you're right.
Yeah, you establish some kind of a dashboard and it says, it gives you a big number, boom, boom, boom.
Yeah.
I think you really have to
Take
embed
action.
yourself within a process. I mean, at 01, we embed it in the investment process and try and disclose hidden fees, transaction costs, and see if you can, that's Marty, right? Apologies. Embed yourself within a certain process, and if you can manage that process, take for example in the investment process and working with brokers and disclosing those types of fees, and then that dashboard in combination with a consultation service can provide some significant savings. But if you're not embedding yourself within some process and getting some savings or reducing some of those costs, then yeah, your analytics. I mean, I was at JP Morgan and ran the equity analytics for 6 years, and exactly like you said, it's like, where's the value that you're adding, Tom? And it's very difficult to
It is.
and to value.
You need it.
Right.
though.
So-
You
so-
definitely
so-
need it. You
So
definitely need
I assume that you've read the book 0 to 1,
Yeah.
Oh, great book.
which is one of the great
Not-
books.
not
right?
only that,
Right.
but
it's a
So-
great-
so-
great
so-
book.
so- so-
leveraged my entire life on it. But besides that,
And again, so that kind of gets back to the whole theme of like,
Yeah.
it's better to find something that's new than to
Yeah,
redo
right.
the same process over and over again, right?
It is.
And so that's in fintech, that's the whole thing, is that like when it comes to like Greenfield, you see like fintech that's been expanded like all over Latin America, where it's making payments easier, things like that. Then you see other, I mean, obviously PayPal is a great example of something that was brand new. And so people are like always thinking about something that's new. et cetera.
Plus, there's a key to the education process of that. If you've developed something new, people are kind of like, hey, what is that? And that's kind of what I.
So the question as an investor is Greenfield's better than trying to redo a process that's in existence already?
I don't know that, right? But there's, you know, the big institutions are like reluctant to change. But there are, you know, there's some people making a lot of money, you know, plugging into like just, you know, not the major financial institutions, but there are thousands of banks in the United States, right? They really don't even have the analytical ability.
Yep.
So, you know, I wrote something on this, and I really believe it, is that it's more like the increase in computing capacity, you know, for us at our fingertips. So where, you know, if you're a small company, it might have cost you millions, like who knows how much JP Morgan has invested in this thing, right? But they have billions in it, but really it could cost you tens of thousands or less to have massive computing capacity in the cloud, right? They just don't know how to do it. And there are thousands of banks and credit unions throughout the United States who have no idea how to do it.
Well, the credit unions and community banks under $1 billion, they don't have the money to be able to invest in innovation, to be able to get fintech to compete with the big banks in the country. So that's like having.
I think that the solutions now in the cloud, they'll kind of level the playing field, or they make smaller companies.
Yeah, but there's a big challenge.
There is a challenge.
Provide
The security. Cyber, the regulator does not let you plug into the core system to be able to extract the information of the bank.
I would see that, and then they're just realistically, you know, like we have a guy, you know, we're working with right now, and he wants to go and build, you know, the company organically at Greenfield, but, you know, knowing there's a massive need with community banks and credit unions, right? There's a regulatory overlay, but then they also move very slowly.
Right.
You know,
You're
so
right.
what is the burn? And I kept on telling them, like, look, yeah, I cover credit unions and banks, you know, trading desk, okay. I mean, they're great. They're very awesome clients, right? But don't expect them to move fast. Like they've got more to lose. It's just their mentality. So you could be looking at decades. Like, do you want to turbocharge it? I think Marty's going to go to this point. Number one, you know, what are you really doing? Are you disintermediating somebody? Because a lot of fintech companies come across as being absolute jerks to people. We had you know, an investor on the phone one time, and he goes, so are you telling me that you're disintermediating me and then asking me for money at the same time? He's like, I hung up on the guy. I was like, I told you, like, would you, like, you know, you're better off partnering with these guys. They only spent like 40 years building this business and managed $80 billion that you started in your garage 6 months ago. I mean, like, they've got stuff that you're going to benefit from, like, tone it down, you know, and part of it's just like the rules, like they allowed these high net worth, supposedly high net worth investors. I mean, someone who makes a couple $100,000 a year invest in this deal. I mean, that was stupid, right? And there were so many crooks out there ripping these people off. I mean, that was a bad idea. I mean, crowdfunding and all this stuff, in my opinion, is a scam. I mean, you know, hopefully they just clean that up, because there is a real need for this. And if you qualify, like, what's a good one versus a bad one, to us, it's, you know, are you increasing efficiency, which could be disintermediation, right? Or are you making the assets yield better, right? Like, what's your game plan? I mean, like, what service?
Those are your two outputs.
You know, the
right?
jump on the bandwagon crap. I mean, forget it. That's all. You're always gonna, like, eventually just get. You're going to eventually get caught holding the bag on that one. So, you know, to me, it's a lot of positive change going on, because you had the naysayers that are now on board. You've got the economic rent seekers that are, it's coming home to roost. And you have a real need out there, right? And you can't get in the way of progress, because then you're going to be, you know, eventually, you know, outdated yourself and hold on to a bunch of low yielding assets.
Yeah, I still like the garage people, by the way. I mean, that's the culture, right? Because you have a bad guys here. I like everyone. but you know, there wouldn't be in Stripe and PayPal's and companies like that without that you know, entrepreneurial and let's change the word attitude and performing, right? But
Well, you have
agree
to
that
have,
there is
you have
number
to have it. I just don't think it's, you know, and you have to bring capital into that sector, right? In order to feed people with good stories. But, you know, there are also disclosures and things like that that need to be adhered to, right? And if you're just lowering the bar, on disclosure, I mean, that's just,
yeah, I know.
how do you think that's gonna, I mean, how did
I agree that needs to be changed. It's just like real estate market, but let
Yeah,
me
the
let
real
me give-
estate, the real estate one is interesting, right? Because you've got, you know, people doing these preferred yield deals and, you know, when rates go up, right, and the cost of funding goes up, you know, that's interesting. So we've actually seen some pools of assets cough up with this huge backup in rates where they weren't hedged. You know, I think that could be a, you know, kind of interesting area, right? Where you could find some very reasonably priced assets for people who thought they had they thought they had financing, right? But they really have funding. They have no committed capital. They have, you know, and I've been fighting that battle for, I feel like forever, is you actually are not set up. You have massive interest rate risk on the way you're set up with this deal. And all they go is, hey, what's the rate? I'm getting 1% of the bank. This guy's offered me 8%. I'm like, yeah, 8% for equity. Okay, good deal, bud. You know, that's not a bad good deal. You should, you know, you're 700 basis points less than I can get you by investing in the BlackRock directly.
Yeah. I just
For the same deal.
I wanted to
Apples to apples, but you know.
got it. Well, thanks. I just want to touch a little bit on the subject of the product that Tom has. That essentially it's an analytical program, like it's a fintech program that takes care of the family offices, which uses the analytics to find hidden fees. So that's kind of a realm of what it is that he's been doing. And I'd like to hear more about it, how it works, and then, you know, can you tell us something about it?
Sure, absolutely. So as I mentioned, it's a combination of a SaaS, software as a service, and a consultation service. I think everybody in the room and everybody knows that the broker commissions have basically gone to zero and even negative with payment for order flow. Yet broker profits are still at record highs. So that causes a bit of a disconnect and quite frankly, confusion at the investor level. You know, you've got Ken Griffin, who's buying a $238 million penthouse. I think you can see it, but you know, if commissions are zero and trading has been significantly restricted at the investment bank, you know, where are these profits coming from? And one of those sources is exactly that, is hidden fees, and we've coined the phrase hidden commissions. And what the best execution system does is expose those hidden fees, work with the investor, the family office, to manage the broker process, and hopefully gain some significant savings from that process. So the combination of combining transaction data with market data, these are all institutional level tools that we did at JP Morgan and another firm that I worked at. But bringing these institutional tools down to the smaller investor, the family office, the small asset manager, puts them on the level playing field that enables them to see these hidden fees, hidden commissions, work with their broker to manage those, and come up with significant savings.
So you aggregate the number of the family offices and to produce like the you sort of compete for these institutional monies with your tool, analytical tool.
Absolutely, there's a peer analysis. So not only can you see what you're doing, but hey, what are these hidden fees? I mean, a recent SIFMA study showed that impact is in the area of 31 basis points on average. But that's including institutions who have sophisticated software and spend a lot on analytics. And I used to work there, and you know that. So for a smaller investor, that's probably 2, maybe even 3 times that type of cost.
Mhm.
And to be able to pay this, a family office that's trading $10 million a month, that's over $350,000 a year. And again, it could be twice, maybe even 3 times that. And by simply conducting a quarterly broker review, basically saying, hey guys, I got my guy, he's got the hidden fees, it's kind of like getting in a taxi. You're on the meter now. I get this, I've got this data, and we're gonna have a discussion about these hidden fees, which aren't on your monthly statement. So, yeah, exactly.
Quick question.
So
Sure. Excellent product. So when you're speaking about exposing these hidden fees and commissions and things like that, and when basically transparency and the world's actually moving towards Web3 and blockchain and all of this, so why not include, just as a suggestion, like blockchain, where everything is about keeping transparent, and when you have like sort of smart contracts and you automatically get transactions or funds moving using crypto and all of it. But using the transparency application of blockchain, why not introduce that so you can have everything transparent and you can expose all these commissions and hidden fees and things like that?
Yeah, no, absolutely. I mean, that's a huge nut to crack. Now you're talking about clearing, exchanges, brokerage, that whole clearance settlement and diving into that. We're sitting at the periphery and just getting the exhaust of that transaction data. I mean, you bring up a great point, and it's going to happen. The DTC and things like that will use blockchain as a settlement process. Until that happens, I'm going to use the SFTP process and
Right.
APIs. And
Is the architecture of what you do is that, so you analyze the existing transactions and fees, and then you also have a database of other transactions that may be external as well as internal. It's kind of a cloud you maintain, or?
Well, it's just the pure analytics. So we've got 10 or 20 family offices. We have that database of all that.
Exactly.
All those transactions. And you can compare, okay, within this sector, how have other investors done within this sector as far as slippage or impact? And mine might be 70, everybody else is at 35. What's going on here? You need to have a discussion with your broker that says, hey, here's the benchmark. When you lower
And that ESG number that you quoted is based on S&P 500 index, the fee structure. You said there was a 30 basis point fee structure on
They
top of
basically
ESG.
took a look at the entire global markets. They did it by country, and the U.S. was an average of 31. I think some of the other countries went up to 70. And things like that.
I mean, this is pretty well known,
Yeah,
especially in the
yeah.
family office space, which is why they always, look at ESG with trepidation. And the public markets, most of the S&P 500 firms have ESG programs already implemented,
Right.
and
yeah,
so all you're doing is paying extra
Right,
from that
right,
indexation to.
Just on the earlier point, I'm curious, so once you discover the hidden fees, are they negotiable? Like, how do you actually make
Well,
money for the client?
Here's the point, is that if you start to expose these fees on a hidden basis, and you say, okay, my average slippage is 65 basis points. And what we're gonna do is we're gonna go to the brokers and say, okay, for the first quarter, let's improve that by 10%. Let's start there. So your benchmark, your goal is now 59 basis points. That's your goal. So your broker, you're basically giving your broker standing instructions to say, this, I know my commissions are now 0, but I know you're making money, and I'm pretty firm that this is a source of that money. So we're gonna start to manage that.
How do
So
they-
basically,
It's just like a car dealer,
How do
right?
they get away with not disclosing that? I mean, that's just.
Sure, they do it all the time. They just run it through different vendors.
Absolutely.
Right. Yeah, and
Yeah,
there is
I- I-
retrocession.
I-
There is
And then
retrocession all over
managing
Wall
the same.
Street, right?
You're on the clock.
Yeah.
And now we're gonna look at it every quarter and see how you're improving. If you're not improving, I might suspend you. If you continue poor performance, I might cut you off. These are what institutions do.
Actually,
I'm just
what you're
taking
doing
these
is a
tools on.
well-known approach in the vendor management space.
Yeah.
It's
Right.
extremely well-known, but it's not applied very much into the broker space.
Absolutely.
Right.
Yeah.
Well,
It's
and-
very interesting.
and my
But
assumption
so
is
here's
you
my
can't
question
change
is,
it.
how do you charge for this? So let's say I'm making $4,000 a year in savings for a family office. Are you taking half of that savings, 10% of it,
We
or
charge a flat fee.
so you charge a flat fee?
Yeah, a monthly fee. And if you could save $1 million, good on you.
Monitoring fees.
Yeah, absolutely.
Do you offer the service as well as the software, or do you offer just the software?
I'm sorry, say that again.
So who does the analysis? You, or you offer a technology product that the firm can do their own analysis with?
They can do their own analysis, but we offer a quarterly, I'm having real trouble with this thing here. I'm Tom, by the way. We offer a quarterly consulting aspect, and what we do is we go through it, we run out all the reports out, and we sit down with them and say, here's what you should do with your broker. And then you should have a conversation with them on a quarterly basis. B, here's the specific things that you should talk about. C, here's the specific targets that you should measure. And next quarter, if they miss.
What you want to do is create like a family office alerts product and send it out to all the family offices in your mailing list and say, we just noticed this trend. You might want to look out for it. We can do an analysis for you tomorrow.
Absolutely.
That's how I would do it.
Hey,
Yeah, sorry, Arthur.
no, it's okay, but I just wanted to kind of like bring the focus a little bit on the fintech in general, because like trying to figure it out. Okay, it's 2022. The market is what it is. What are we seeing like in the trends of where the fintech is going? I mean, we talk about the analytics, which is great, and then having a SaaS tools, but what do you see the trends like embedded into the product fintech? Wearables, IoT. What do you guys think about that aspect of the thing? I mean, can you perhaps you have an opinion on it? Just the curiosity on the outlook of where we heading outside of our own internal SaaS tools.
All right. So again, not an expert here in terms of how fintech is, but of course in real estate. But I'll leave that question to the professors here in terms of how lending and fintechs sort of perform. But just giving you a bit on real estate finance and real estate investments. So it's currently, I think it's a $16 trillion industry, just US alone. And this $16 trillion, it just includes sort of real estate infrastructure, but not energy and other sort of infrastructure, medical infrastructure and all of that. So what we are trying to build is not just for real estate space, like not just for $16 trillion. And it's a number that we cannot count in terms of how much there is market in terms of cross-border investments, not just in the US alone, but there is so much cross-border investments going on right now. US investing in India, all these developed countries investing in developing countries. So when I was sort of invited as a special guest to the G20 engagement group, part of G20 summit, the whole discussion was, this was pre-pandemic, the whole discussion was, people are not just looking at investing in a property next door, in a property sort of the city, the city which I know. People started investing in properties at the city, in the location which they don't know, which is a bit of a higher risk, but provided you give them the right information at the right point in time, in terms of surroundings, in terms of risk, in terms of the stakeholders to work with, you can increase that $16 trillion market or whatever that is to, 3-fold, 4-fold, because people are now willing to invest across the world, provided they get the right information. So I think it's all about the information, the economics of information. But yeah, leaving that fintech question to others.
Actually, it's a real intriguing thing on real estate, because although people have been willing to invest across the world, we're going through a period of deglobalization. So I'm gonna like to see what happens with that. Since Russians were such big buyers of New York City real estate for a while, weren't they? Right. So it's gonna be intriguing. So, I like to look at fintech investing as a tool set versus a platform, right? And I always want to find out what's the argument for what you're selling as a platform, because that's where you make money, versus a tool set which has a short lifespan, I think, right? So
I completely agree with you on that.
And what's your business? I mean, really? Are you a consultant? Are you a company? Yeah. As far as the trends, look, it's always been about asymmetrical information. The person with the best information has the best pricing ability, right? You have to assume that there are very, very smart people in this business, and the incentives are so great that they're going to find the best way, right? So, there's a reason why there's specialization. There's a reason why people focus on industries, et cetera, because they're either they interpret the information better or they have more information. That's the way Wall Street's been set up ever since I've been in the business, right? The tools get better, right? But they're not gonna just change what's working. Their fiduciary responsibility is on trillions of assets, and they're not gonna move it over to something quickly. And when they do move it over, there's a boom, right? So where are we now is just the question. We all know that deal volumes are down, right? Early stage fintech company investment has been bad for a couple of years already. So, I mean, if I could filter out every Series A deal I got, it's a lot. Okay, they're everywhere, but the deals are getting bigger. Companies are getting more mature. The business plans are becoming better. So it depends on is it a great time to raise capital relative to what it was a couple of years ago? There's no comparison, but it's not a bad time to raise capital. So if you want to build a business, it's there for you. Don't forget that the financial institutions, which one way, shape, or another, people talk about disintermediating, and all this technology talk. Amazon, for all we know, would have never been Amazon without the investment bankers and traders saying that business strategy sucks. Okay, and we're not underwriting it, we're not buying it, not investing in you. Like some way along the way, Bezos had to shift because no one was buying it. Okay. And it's the same thing that's going to have to happen in the fintech world is you just can't go plug in and get more money and more money and more money without having a business. So I love the discussion. I think it's a very healthy time. I think that's a good thing if you want to build a business. If you want to go, sell your company at a crazy valuation, well, it's not that great of a market for it anymore. But it's not a bad market for it either. It depends on what side of the coin you're on. If as an investor, I think it's great because, you're looking at people that, can get taken out a year or two from now, 3 years from now, from a major financial institution that's already bought in that this fintech story is for real. That there's institutional acceptance for it. That gives you immense scalability. So I like it. I think it's a good time. I think valuations are more reasonable, and I think the companies are more real.
Great. Well, thanks.
So actually,
yeah.
Just 1 second, Arthur. So you had actually spoken about a Series B, C, D, E.
Yeah.
And I was looking at Robinhood's price. They're at $9 today, and their high was 55, I guess. So you're talking about people selling you stuff, and maybe it's really
and who did they sell it to? Like the retail investors, and you're telling me they have more information than Goldman Sachs? Please.
Yeah, well,
they've got no clue. I mean, they've got relative. I've been doing institutional trading, and I am telling you, there is not a single retail investor in the world that can have more information than someone who's seeing the flows every day, right? That has millions and millions of dollars of research in it, just maybe billions, right? That eventually you're going to need anyway. So these retail investors are not taking over the institutional guys anytime soon. It's never. It's economies of scale in underwriting deals, right? You really think that one person on their own is going to be able to underwrite a deal and then be able to trade in more than one name? It just does. There's economies of scale, there's specialization, there's reduced transaction costs because of the economies of scale. People aren't disclosing the transaction. That's a whole nother ballgame, right? That is, to me, I can't believe it exists.
That's just an operational issue.
But that's an awesome solution, right, to a problem, right? But there's still some things that work, and economies of scale of financial services companies works. It's impossible for someone as an individual to have more information or more time than someone who is an intermediary who sees the flows. That's the whole point of an intermediary in the beginning, is that they could see all the information coming in and then share it to someone who's gonna make an investment. And as far as the transaction cost, man, it's like hiring a lawyer. You get what you pay for. I mean, I like hiring good lawyers, because they're always worth the money.
Is the first question you ask is what's the exit on a deal that comes to you?
What I actually say is, what's the strategy? And if the strategy is raising money alone, like we try to marry a capital plan with the business strategy. But if they don't have a business strategy and they ask us to develop it, then it's like, hey, you want a consultant? You okay? Then, you know, maybe we could be a consultant, but you know, if you want to raise capital, we want what your business is before we raise the capital, right?
So.
We got about 10 more minutes, Arthur.
Yeah. I just wanted to ask, in terms of like new types of the solutions and products. I understand all this, you know, great analytics, but you know, I'm still the garage guy here, trying to defend embedded financial products and like things that other people didn't think that could potentially exist. And then just for example, a lot of transactions right now are kind of like built into the fintech transactions are built into the small IoT type of devices, and they're embedded into charging stations, you know, EVs charging stations or rings that contains your digital wallets, and those guys are trying to also get into the fintech from the point of view of conducting the transactions, like, well, not even a, you know, fraction of the penny for each one of those transactions, so they don't take a lot of necessary out of the whole pool of available transactional fees. So I just wanted to ask Phil, you know, if I understand that you guys are all kind of in the analytical world of what's happening in general in the financial world, but just wanted to see your view from New York, right? Like, how do you see those things that are coming out and then they just around the corner?
There's so many great ideas out there, right? With the ability to democratize basically the computing power, right? And it leads to all kinds of interesting niche businesses out there. But you know, you got to get clients, and I'm sure that you know these guys know that. You got to get clients, just like I do, right? We all need to get clients.
You can't just play with data.
Yeah, that market, you can't just. But if there's a need there, right, you tweak it. You know, you adapt. You know, the realities on the ground. But there's so many interesting, cool businesses that can come off of the ability to process this massive amount of information more economically than ever before.
Right.
Amazon has just made it so easy to spin up a business. You know, to your point before, it's the investment banks are spending all this money and they have all these analysts, and there's, you know, I think less.
That's kind of my business, right? Like I could compete with someone that like JP Morgan would honestly, like it's not a few $1,000,
like that. I mean,
it's
it's so easy.
Yeah.
Spin up a
I might not have the
service
information.
application,
Yeah.
FTP data, and assessing that. All the tools are there. And
Can you guys address unstructured data? So like, I mean, you know, there's the data, so like the data that Wall Street's always relied on has been there, but I get people like saying, well, you know, we have drones and we're tracking all the traffic out of IKEA to predict, you know, new neighborhoods that are becoming gentrified, stuff like that, right? I mean, do you guys have any thoughts on this kind of unstructured data that's out there that people have not been tracking that might be, you know, insightful? I mean, I know analysts for years have tracked number of cars in a Walmart parking lot, stuff like that. Any thoughts?
I think from an unstructured data standpoint, I think the cost is so high. What we try to do is look at external data. As an example, I did a project with healthcare and tried to embed, took a look at a data set and look at the transactions, and went outside and doctors are rated at certain websites and things like that. To incorporate that data into the analysis is key. But you know, you guys might disagree, but getting that unstructured data is a big lift. And like we said, it's easy to get something up and running pretty, but that's where you start to say, okay, well, you know, we really need computing power, intellectual power, and things like that. So it's difficult to apply the unstructured data.
Interesting.
So just one comment. There are two things that I just wanted to address. One thing is basically institutional investors. They have sophisticated systems and they do all the analysis and stuff like that. So that's true. That's relevant in terms of the stock markets and all of those things. But considering real estate, where our potential customers are between close to $550 million to $20 billion, all are institutions so far that we signed up. And looking into their real estate systems, how do they look at different projects and what analytics they do? They have these Dropbox kind of view where they have just plain papers, documents, and so much data of the property. And they use platforms like Costa to see GDP inflation. And there are 2-3 analysts actually trying to marry market data with property data and giving out sort of taking decisions. So with respect to real estate, it's still very old school. And even whether it's a retail real estate investor or like a $5 billion or a $10 billion institutional real estate investor, I would definitely say institutional investors in real estate are doing much, much better than retail, but still there is so much gap with respect to retail and institutions that the way they handle data, and there is no platform which is rightly ingesting and giving out the analytics on what needs to be done. And with respect to the unstructured data, one thing that I said is market data, and then there is the property data, and then you get to those together. And the third type is my behavior. So this deal is good. Maybe there are 3 deals. All the 3 deals are good, the great yields and everything. But I have my personal risk tolerance, right? So all these three deals might give, they are great. But when you drill down into each of those information, those deals might not be suitable for that type of investor. So when you're doing
for you, sure.
Yeah, when you're doing the analytics, it's really, really important to give the personal preferences and taking out the investment behavior based on the previous investments you have made and with how many of them you're happy. And unstructured data, there might be a news. Oracle is moving from California to Texas. With just that one single thing that happened, the whole housing situation collapsed in many areas, right? And how do we capture that data? So definitely one point Phil made was, it's hard for, retail or institutional investors to have, all the information out there. Of course, institutional investors have resources to get so much information so that they can make judgments. So we launched a feature to actually capture unstructured data. Is most of these investors, real estate investors, they get information through phone calls. How can you feed those phone calls into these models rather than putting like a bullet point there that, there might be a higher inflation in like a pitch deck? How can you incorporate that unstructured data into model so that model automatically bootstraps and gives you a result on how unstructured data can actually be used to make judgments. So that's what we are exactly working on.
I guess one thing I just want to circle back to before we end the discussion is that Phil had mentioned, that there's this, segmentation between institutional and retail investors. Yet, you've seen this explosion of ETFs, obviously, which has kind of changed the game, right? That's number one. And then secondly, liquid hedge funds have exploded in volume, right? I mean, they're like, it's a multi-trillion-dollar space, right? So before we thought, hedge funds were just.
But ETFs are like single name privates, like, or things like that. And, the trading is different than, investing, but.
Right, so the activity is different, right? So,
The activity is different for sure. Yeah.
Right, so I'm just saying that, if you look at the marketplace, there's a lot of, you have to kind of balance between the opportunities, because I've always thought that tokenization and real estate, for example, is going to make real estate valuations go much higher.
Well, I love the idea.
You said that people are international investors.
The advantage of all this technology for the retail investor, especially if you can bring more integrity to it, right, through all this technology, is that, the bigger institutions are clumsy with the transaction costs. So they always look at the biggest deal first. And I for years wanted to just find a partner and aggregate a bunch of small balance commercial real estate deals, right? And, automate the underwriting, to make it really good. And then, exit in the capital markets with a huge, residual, right? And I've even gone to some big investors I want to mention. They're like, well, go do it, Phil. We'll take you out. I'm like, yeah, but I'm going to sell it to you at a premium. They're like, that's fine.
There's actually a guy in Silicon Valley who's done this already.
Yeah. So if you could lower the transaction costs or bring better integrity to the system, then all these small deals become at play, and the big guys get kept. That's where the retail guys or the smaller guys get advantage. right? They don't have all these, red tape. But then again, it's like, you need, sort through it better. So if you can sort through it faster or better, it's good.
Yeah,
Fantastic.
actually, there is a company, by the way, Sai. I mean, the John Longsdale with the Peter Thiel, they set up a company, Palantir, way back, that does the analytics that actually digests all the information, and they created another company called AdPar. And AdPar exactly does what you're describing. Is essentially you digest any kind of information, but not necessarily from phone calls, but from any source of information, and then actually to convert the raw data into some kind of a decision-making point. And they've been around. The Palantir has been really successful. At par is I don't know where they're standing, but they've been out there for quite some time. But the data is the king, as they say.